Hi, and welcome to another Unlocking Homeownership with Kevin and Nikki.
Kevin?
Kevin and Nikki Campbell, the illustrious Campbell team. And today we're going to be discussing 10 reasons, the 10 most common reasons, at least as far as we believe that when buyers are applying for a mortgage loan, that the underwriter disqualifies them. So we're going to kind of go over that today. But as always, before we get started with the business of the day, we try to spread some knowledge on you for a second, and we try to throw some fascinating facts at you.
5 random facts, fascinating facts in 5 minutes. So here's some, normally they're not about mortgages, but today Kevin was on a good one. So let's start with number 1. Small businesses create 64% of all new jobs in the U.S. each year, and almost 30% of Americans are self-employed.
Yeah, so this is a big shout out. Nikki and I participate in a lot of like legislation action team. Nikki's a member of the local chamber, and so this is an important piece for us. I was actually surprised by that number, to be honest, even though we actually are part of the chamber. It was a big number, but for us, we wanted to call out all the small business owners who contribute so much to the economy, and those 30% of you out there that are self-employed, you're those entrepreneurs. Thank you so much for what you do as well. We didn't want you to feel left out. So, what's the next one, Nikki?
Number 2, U.S. household debt is at an all-time high, regardless of what people say about our economy. Anyways, the total household debt of $17.3 trillion entering 2024 is a new high for U.S. The largest increase in any category was credit card debt, which swelled by 16.6% between 2022 and 2023. Q3 to Q3 2022. Hi, Bree. So we see this a lot. We pull people's credit, we look at their credit, and although on the outside it seems as though people are doing well, there's a lot, I think people are just using their credit cards to kind of get by. So there's a lot of credit card debt out there right now.
Yeah, unfortunately, these stats are Googleable. You can confirm them for yourself.
You didn't make them up?
Yeah, straight off a government website. But it is pretty sad that there's, what was it, $17 trillion in debt by individual households. And a large part of it is just people living off of credit card debt, which is, we'll get into later, how that grossly affects people. Not just the interest rates, folks. It's keeping people out of houses.
Number 3. You want me to go? You go.
I can go. This is pretty funny. I thought it was pretty funny. So
that's why I said you should do it.
According to the Federal Reserve, who conducted a study, that the larger the gap between you and your spouse and your credit scores, the more likely you are to have your relationship resolved in divorce. I need to go check my credit score.
Wow.
Speaking of spouse and credit scores, there's even a website out there called creditscoredating.com where you can match yourself up with someone just based off credit scores. So,
is that directed to somebody watching right now? Just kidding. Don't say it.
No, I'm.
We're just trying to help you out. Find you a, full-time lover.
Yeah, I'm leaving that one alone. Number 2. Did you know that I knew?
Number 4.
Yeah, number 4. Did you know that if you max out your credit cards, like no late payments on them, but just if you carry the highest balance possible, that it may dock you up to 45 points in your credit score? I knew it was always important to keep a low or lower than the credit limit, but I didn't know if you brought it all the way up there.
But so the information I've received that I've followed all along is that 50% of the limit, if you have a balance, is 50% or less of the limit helps your credit score tremendously. But if you have a third balance of the limit, then you're like really doing
I thought it was surprising that it can hit your scores as high as 45 points if you let it get all the way to the top. So something to keep in mind out there.
Go for it.
Okay.
You're all about the Great Depression stuff anyway.
I'm a firm believer in the greatest generation, right? So number 5, the greatest generation, those of us who still have grandparents around, that's them. They suffered through the Great Depression, the Dust Bowls, those kinds of things, right? And because so, they were very frugal in their spending and their use of credit, and they had some of the highest credit scores. I think on average they were in the 820 range.
Oh.
Piggybacking on that fact, Gen Ys, which are people that were born between 1981 and 1994, which
not me.
People running into the market these days, are having the lowest credit scores of any generation out there, with an average of about 672. Again, these are government facts, not mine. But
really,
yeah. So I think we need to. Again, my point, I guess, that I'm throwing out there is, if you have somebody in your life who's younger, or you might want to just help them out, because I don't know if they're getting the same education.
I think that just credit is just a huge lack of education, and I only learned credit as I've been watching people through the mortgage industry and just reading different articles. But I started just really paying attention to see, like, what does this person have versus this person? What is this person with a really high score versus this person with a really low score? And like, I just want to use an example. I talked to a customer yesterday, a soon-to-be customer yesterday. He's 21 years old with a 780 credit score. Mm-hmm. And so, like, it's not always the older people that have good credit. Like, he's doing fabulous. He's managing his credit appropriately. His parents have sat down and talked to him and told him, like, what credit does for you, what the benefit of it is, what the negatives of it are. They're looking to build a house. And so him and his fiance, and he's just doing a fabulous job. So it doesn't take a lot to do it. I think it's just an education.
I think the point, though, is that we run across probably, for every one of those, we run into 4 or 5 that didn't get the education.
Yeah.
And like,
they know nothing. They didn't know much about it either, but yeah.
Every time somebody offers them like a 5% discount at a clothing store, mm-hmm. then they go take that $200 or $300 card, mm-hmm. and then they, for whatever reason, maxed out. Then, because they're just not paying attention, life's busy when you're young, right? And then you, God forbid, you miss a payment on your like $300 credit card at clothing store X, and then now you're in the 600s, right? And it's just a terrible situation.
Or just getting a bunch of credit card debt because you want what you want right now. I mean, I'm guilty of that. I want what I want. Like right now, I don't want to wait, but I obviously see this every day. Anyways. Yeah.
So today's topic is really not something that Nikki and we contemplated this for a long time about when and where we would place this conversation. It's not something we enjoy. It's not some of the niceties that we're like, oh yeah, let's go out there. But we do think it's valuable. And I guess, Nikki, tell us like some of your thoughts about like why credit is like initially just at the initial elevator level, like why is 10,000 foot level, I guess.
Yeah, so like top reasons why people get disqualified for applying for a loan. It's not a fun subject to talk about, but like, we all have a different story. Everybody has a different family. You were raised different, your parents taught you different, or teachers, or what have you. And so I just think, again, the lack of education is huge. Everybody out there has just a different need in life. They're different, jobs, all that sort of stuff. So I just think as a whole, it's just nice to be able to have the conversation to say, hey, just because maybe, your score is really low doesn't mean that we can't bring your score up and help you figure out how to make that happen so you can become a homeowner. Or even if you don't want to become a homeowner, just be able to have a better credit score. So much is revolved in our life around credit and credit score. And this isn't a conversation just on credit score, but I think we find that in our world, besides income and, debts, like credit score is just a huge factor in most things.
And whether you buy a house or not, credit worthiness will grossly affect about how much
Even your dating.
how much you work. It will grossly affect from your auto loans to like most everything. It will grossly affect how much you spend through the course of your life.
I mean, I think it just even affects like if you can rent a house and such. You know what I mean? Like it's just one of those things. And some people just don't have options, and I get it. Some people just have bad credit because of circumstances that they're in. So this conversation isn't about like shaming people for what they have. I think it's just solely should be on an education basis of what can we provide to help people understand it versus like making you feel bad about it. We've all had bad credit. Maybe not all. I've had bad credit. You've had bad credit. You know, like our families had bad credit, and we've just tried to work our way to get out. So if you're one of those people out there with bad credit, your life isn't over. We can.
Yeah. So number one reason we don't want is a low credit score, right? And so we'll speed past this because I don't want to feel like we're beating a dead horse.
Yeah.
But missed payments is the number one reason for a low credit score, right? Mm-hmm. High amounts of debt on your card. So like Nikki was mentioning earlier, like if you happen to have maxed out your whatever amount of debt, limit that the individual investor has given you on whether it's cars, installment loans, credit cards, whatever. If you're maxed out on everything,
installment doesn't hurt as much, but yeah, credit cards really gets you. Mm-hmm.
Yeah.
Missed payments, like people don't understand the gravity of what a 30-day late does to you. A 30-day late, you can like have your credit or your limits where you want. You can have like the, you know, be doing fabulous, and then you miss a payment by 30 days, and it just tanks. So I'm always an advocate to say put reminders on your calendar, do whatever you need to do. Hurts you.
And to kind of just the next step to that, like derogatories or things in collections, is an absolute devastation, right? So
yeah. I don't know if you saw that. There's news coming out soon that the CFPB put out that they would like to remove the ability for creditors, credit companies, to put medical collections on your credit report. And that's huge. Like myself, I have insurance. My doctor submitted a lab result or what, you know, my lab work or whatever to the lab, and the lab didn't have my insurance, so they charged me a bill but didn't send it to me. I didn't get it. I pay my bills on time. I checked my credit for some reason, and I had a collection for a lab bill for like $23 in collection, and it just kills your credit score. So I think those are the reasons why they're like, hey, you can't really put medical collections on. I mean, you can right now, but they're trying to pass a law that you can't put medical collections, and that I think that'll help a lot of people.
And the last thing about credit specifically is the length of your credit. Mm-hmm. So one of the things that I see a lot of people doing, and this, you know, whether you're young or old, I see people doing all this time. They're like, hey, I've had this debt for a long time, and man, I just got done paying off that credit card, right? So I just don't want to get in debt again, so they just cancel it. Freeze it in a bucket and put it in your freezer. But like when you do anything, but when you cancel, like when you manage to get on the other side and you paid that credit card down and you've had that card for like 3 years and you go ahead and cancel that, you probably hurt your credit score worse by canceling that and alleviating and removing that line of credit history from your credit history than you would if you just left it open and chopped the card up and didn't have it in your possession. So a lot of people will go and make that mistake. So don't do that. Yeah.
So again, longevity. I always tell people this. I have a credit card that I've had since I graduated high school in 1994. And so I have a history for 30 years of a debt that I've paid on time. It's a ridiculous credit card, low limit, whatever, but I use it once in a great while. And it just shows that I know how to keep my history up and I know how to like manage my credit well. So that's an example.
What's the next one, Nikki?
Shout out 1994. Okay, high debt compared to income ratios. So when we're looking at your credit profile, your income profile, we're going to take your income and your debt. So we do the calculation to see what your debt to income ratios are. So some people will come in over 50. The standard is really like standard's 41. We can go to 43. Some programs allow 50. Some programs allow 56. Some programs are allowed 60 for higher income earners, because your leftover income is a lot higher. But really, a lot of the issues that we see are people just have that really cool truck they have like $1,000 a month payment on, and that just took $1,000 away from your ability to have a housing payment.
Trucks are,
So-
we call out trucks specifically because
It happens a lot. Or that cool trailer or
Yeah.
four-wheeler.
when you combine the recreational vehicles, all of
Yeah.
them, like the 3 of them, together, then it tends to chew into it, right? So a cool little math equation that you can do to kind of test yourself, and you can look these up online, but you can add up all your debts. And when I say debts, I'm not talking about your cell phone or your cable. I'm just talking about the things that would show up in your credit report.
Which are people that don't
credit
know.
cards, auto payments, installment loans, like anything that you got from a bank,
loans.
student loans. You can add up the minimum monthly payment of those and then get that number. And then you can add up your monthly income.
Which do you use? Gross or net?
Gross.
What does gross mean?
Gross is the total amount of money you make before you take out your taxes. You add that number up, and then you would divide your bills times your income, and then that's going to give you a decimal, and you just times 100, and that'll give you your percentage of DTI. And again, we should try to, as people, we really consider over 50% unmanageable, right? So if you're trying to buy a house, all your current bills plus your new mortgage payment would really start to, the bank will have a hard time qualifying with over 50% when you add the bank.
So 50% means, like Kevin's saying, we're going to take your gross plus all your debts, 50% debt to income ratio. So it leaves you 50% for taxes, food, gas, all those
Unexpected
things.
auto
And
repairs
sometimes those
like
things are pretty tight in that instance. So we have to watch that pretty closely. The last thing we want to do is put you in a home. But it's a good way when you're thinking, like, should I go buy that right now? You should just do it. Or call us and we'll help you.
Yeah, we certainly would.
Was that a plug?
That's a plug.
Okay, what else? What you got?
The third one that a lot of people don't think of, but it is probably I would say it is number 3 for us, and is the problems with the property, right? You go and you look at a house, it's beautiful, right? Everything it meets all your hopes, wishes, and dreams, but then something happens. It either doesn't have a clear title, which means there's a judgment against it somewhere. There's a lien. Somebody passed away and it doesn't have a clear title, so whoever's currently you're talking to doesn't have the ability to sign off the deed, right? So there's
maybe it's in a trust still or something like that, and whoever is in probate.
Yeah, so this is why the title companies are so important and why they're such a big part of the process, right?
Shout out title companies.
That's why they're so heavily involved in processes to make sure that that can get in the way.
Right.
And then our least favorite thing these days, right, is
not least favorite, just the
least favorite.
When you get through the hurdles of people's credit, and then you get through the hurdles of their income, and then you get through this whole financial status, and then you order an appraisal,
least
and
favorite
then
thing
boom,
the last day or two.
The appraisal happens, and you're like, crap, I just worked through all this other stuff, and now the external piece, that not that we can control the other pieces, but there's just a lot of moving pieces with purchasing. So appraisal issues happen, and sometimes it's low value, sometimes it's maybe you're
repairs, calling out of repairs.
Mold in a shed.
Yeah. So
I'm just talking about current things.
An appraisal is different from a home inspection, right? They're two different purposes, but
the value doesn't come in.
The value doesn't come in.
You have to negotiate or decide.
Yeah. And so this can be a very big trigger. Emotions can get high with with the appraisals, right? Because it typically happens late in the process, and everybody's kind of on the downward slide, and then something comes in like this, and it's like a punch from out in the middle of nowhere, right? And so,
because an appraisal is an educated opinion of value.
Opinion being the key word.
educated opinion, and appraisers, as wonderful as they are, they have some thresholds that they get to be within. And so sometimes their threshold doesn't quite match up to maybe the agent's, the real estate agent's thresholds, or even our thresholds that we think the house would be worth, or what have you. And so there's just a lot of movement in it. Sometimes an appraisal will come in and wipe it out.
Customer disruption. Customer disruption for sure.
We all know this. We all know it. Yeah. Yeah.
What about the next one?
Missing documents. So Kevin wrote here legal court records. So we've recently had a transaction. I'm just kind of talking about recent ones because that helps. Is that like some folks on the other side of a transaction, it was not ours particularly, but they were, I guess, going through divorce. So sometimes if you're not up and up on everything that's going on in the transaction or in your life, I mean, it's hard because Kevin and I, as lenders, we kind of need to know everything about you. We need to know your entire financial package. We need to know everything that's going on. And sometimes it's a little difficult and a little invasive, but it's only so that we can catch those things that we know what's going on. But, you know, the husband was trying to buy a new home with his new significant other, but not quite divorced. And then now the soon-to-be ex-wife put something in place that stopped him from purchasing. So yeah, it just kind of, some of those things happen. Sometimes we find out that court records could be like you have child support or alimony that we don't know that you have to pay. And so sometimes that will change your debt to income ratios because it doesn't maybe show up on your credit report, but if you do have alimony or child support, we have to include that in your debt to income ratios. Maybe you have a tax lien that we didn't know about, and we have to include that. I think the point to it is like, tell us so we can help you figure out how to get through those roadblocks.
Yeah, almost anything is achievable once if it's communicated out in the open. But you know, I'm divorced, you know, so like once you're on the other side, well, not currently, I'm married now, I'm happily married. But you know, like when you get divorced, it's like you just go, you file that document in a box, and then before you know it, 10 years ago, it ends up in the attic in a plastic box somewhere, right? And then you're like looking, then some lender asks you like, hey, where's your divorce decree with your child support order in it or something like that? And you're like, what? And then it's like this, it's this terrible rigmarole, and God forbid if you moved and you can't go to the courthouse. It's like, it's a thing, right? And then so that comes up, right? You know, you have a dependent who's on Social Security disability, and we're asking you to prove that it's going to continue for the next 3 years, and you're like, oh my gosh, and then
yeah, and it gets a little hard. I think it gets complicated because our customers sometimes get a little frustrated, and I don't know if they get frustrated, but it's like, man, why are you asking for this? And it's honestly, we just want to make sure we're setting you up for success. We want to make sure you can truly afford the payment. And so our underwriters have to have the documentation in file. So unfortunately, we're the bad news bearers that tell you you need that, but it's just something to be prepared. And it is something that causes, like, you'd be surprised how many people just forget to tell us that they pay like $600 a month in child support, and then we get down the line and now they can't afford it.
I see it as a big administrative hassle. I'm not a fan of paperwork, right, guys? And but it is something that gets in the way often. So we just want to call it out. And I'm, you know,
employment history, Kevin.
So you have to show sustained, you know, that you demonstrate that you don't have any gaps in employment, and if you do have gaps, they have to be explainable, blah blah blah. So a gap of 6 months is, I'm sorry, I'm gonna mess this all up. But it's so
usually a gap is 30 days or more. Just requires an explanation. Doesn't mean you can't have a gap. It just requires an explanation. That's it.
30 days.
Yeah. 30 days. Yeah.
And if you move
within the last 2 years, we only look back 2 years. So if it was 6 years ago, we don't care. We look back 2 years. So any gap in the last 2 years, we just want to see consistency that you can hold a job and make
Yeah, this is the hard thing for me because I've only had 2 jobs in my whole life.
Well, you're not doing good at this one. No, I'm just kidding.
But and overtime and bonuses are a big deal in calculating those. So like you could be working one job and then have substantiated proof of 20 hours overtime and $5,000 in bonuses, and then you switch companies, especially in the middle of a transaction, and we've seen it. And then guess what? That overtime and bonuses, if the HR is not willing to, and most HRs are not willing to guarantee that that's going to continue for the next 12 months or foreseeable future, then it vanishes from our math. So it's a big deal.
Yeah, so we don't want to say like don't further, like, oh, don't take that new job that's going to further yourself. But I've had people call me that are in the middle of a transaction, they can't get it done because now I had one recently that we just couldn't get done. The customer was making a great salary and she switched jobs to go to a smaller salary, but with bonuses and restricted stock options. So it was obviously a much better job for her, but on paper, she was making less money. So it was like there was no way around because she hadn't been, accruing that income yet. There was no real way to show that it was going to be a better position. Logically, we're like, it's a better position. Now, are there avenues that we can take that? Sure. We could take that to a non-QM, which we'll talk about that in another one, non-qualified mortgage. But if you're trying to get the best rates, best programs, best everything, it does kind of put a little kink.
Don't quit your job until after the.
Don't quit your job after the loan closes.
Well, don't
either.
change jobs.
But
so we talked about overcoming communication.
Yeah.
And
this one. What's this next one? Proof of funds for down payment and closing costs. So that's the last one. So when you have a down payment of $10,000, we have to see where it's coming from. We have to see the source and season and every transfer going into that source and season. So it does get complicated, and this is where we say it opens a can of worms because you could have 2 months of bank statements, and on that first month there's a maybe the first month there's a large deposit from somebody, and now you have to go back and you have to figure out where that large deposit came from, and then you get that deposit, and that deposit has an even larger deposit on it, and it just goes down a rabbit hole, and Kevin gets really tired about that. But source and season, we need to make sure that the money that you're using is not a loan. If it's a loan, then we, some programs allow it to be a loan. If it's a loan, we need to know what the payment would be on the loan. Like, we just have to know where your down payment's coming from.
In a previous life, I was a federal investigator, and sometimes when we're sourcing documents, I feel like I'm back
as an investigator.
Yeah. So like it's like everybody is connected in like some layer to the mafia or something. It's it's a really
Kevin has a hard time getting all up in everyone's business, so he feels like, why do I need to know where that deposit came from? Unfortunately, our underwriters want to know. So we know that you're good people. We know, and I don't think our underwriters don't think you're good people, but they have to actually write a letter on every file as to why they're approving your loan. So they have to be able to substantiate why they're approving your loan. So I sympathize with them because I've been on that role. Kevin's just like, just do it. Like, who cares where the money came from? Just give them a loan. They have the money, they're showing it, just give them a loan. So
I highly doubt some of the people are. I just have faith in humanity, right? I'm just a little, maybe too trusting.
Yeah, I think we do too, but I think underwriters do too, but their job is to protect integrity.
Yeah. Okay, guys, so those are the top 10 reasons or so that we feel like most loans end up being disqualified. There's certainly some one-offs out there that, happen, but those are really the big ones, right? And so, again, whether you go with the Team Campbell or whether you go with somebody else, I really think that all of these things can be overcome with like early communications and open communications. And then I think, the next thing I would tell you is that, knowledge and experience matters. And so, again, whether you use a I would just interview your loan officers and make sure that they have a suite of products that can adjust if your situation adjusts, and that they know how to foresee challenges and then get in there before it happens, right?
Mm-hmm. Yeah, it's just really, like you're saying, it's just that education, communication, figuring out how to make it happen.
Yeah, so we're gonna close up. We've been chatting now with you longer. We're 10 minutes over our time. Our next episode, guys, will be on July 11th, same time.
July 11th.
Yes,
Is that 2 weeks from now?
It's a little over 2 weeks because we're going to be going to Japan, and so.
Why are we going to Japan?
We're going to go see our grandbabies, and so we'll see you here on July 11th. And
what are we talking about?
We're really excited about the next episode. Our next live. We're going to be talking about our CMG exclusive product called the All-in-One. The All-in-One is a HELOC in the first position, which for the right buyer can
with a sweep account attached to it. So that's
sweep account, which means you can have a checking and a debit card and all these other, like all the same things you would get a traditional checking account. But the 2-second pitch is this product can, for the right buyer, can cut your interest significantly. Like in some cases, we just did one and cut it by 50%, and it will cut your amortization schedule or the amount of time that you're paying by over half. Right?
Yeah, so this particular customer went from paying it off in 30 years to 11 years. So we'll see. We'll talk more about that next time.
We'll talk more about it. So if you get an opportunity or know somebody who might be interested in something like that, come join us on July 11th. Till then, we wish you guys the very best. If you need us, call us. Bye, guys.
Bye.